Fed meeting set to make crypto go boom. Here we go, crypto fam. Strap in. Question everything. Trust nothing. Welcome to Debate Crypto. Let's get right into it. We have got Jerome Powell speaking. I'm going to pull it up right now.
Why, in response to these events,
Can you hear,
the
Crusader?
Reserve, working with the Treasury Department and the FDIC,
Yes, sir.
took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories.
We leave that one out.
Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country.
Yes, sir.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Somebody hit him with some heat. Come on. We never get any heat on these questions.
Thank you. Colby Smith with the Financial Times. How confident is the committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, Just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words.
These rehearsed answers piss me off.
So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Don't worry, guys. The banks are safe. We're just going to print them to death
Mr.
no matter
Can you
what.
explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the
why
words
call it
may
firming?
and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So
Soft
Are you
landing,
concerned
folks.
that the hike you did today could further exacerbate the problem in the banks?
no, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
But yeah, they're still thinking about $18 trillion to make sure that all the banks are safe.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that did turn out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SCP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, And it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and stronger labor market. So that pointed to higher rates. And then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle
Many
it.
banks, the ones they want to handle it just fine.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed Board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
Ooh.
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes, I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But yeah, absolutely, absolutely the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue, and we don't really see it yet. It's so people are making estimates. People are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, And that argues for, being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank and whether this
He's not gonna
suggests
answer this.
that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
He's going to skirt this.
So let
answer.
me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong?
Fractional.
Try to find that.
Reserve.
We will find that.
Thank you.
And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that.
Oh,
Vice
he
Chair
wouldn't
Barr
answer
is
it.
leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
No. These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening of credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from, tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
And one other question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
Not a chance.
And if I can follow on that, but they're
Not a
working,
chance.
the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps, part of what was driving inflation.
They
but that's not
effectively
really
gave
the
away
story.
trillions of dollars. What were people going to do? Dumb people
Hi,
spending
Chair
dumb
Powell.
money.
Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC. So there's no
Because you
risk
just
in it
print
for
it.
us.
Because you can just print it.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you.
Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're We're going to be watching to see what that is, and we'll also be watching it what's happening with inflation and in the labor market.
Remind me to talk about
we'll
that.
Be watching all those
later.
things.
Credit tightening,
and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So, so people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of
the printer works just fine
to run off predictably and passively is
Got
working.
ink. It's ready.
And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless what happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors?
Well, I'm not saying anything more than I'm saying. So but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Wow.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that
Can you say those
merger
words
happened?
nowadays?
Sure. So, that was
He
really
said
the
rule of
Swiss,
thumb earlier, too.
government.
We could talk
We,
about
of
that.
course, we're following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well, and I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
The markets have accepted it, like they had a choice. Sink or swim.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the
Bitcoin's
summary of
dumping, by the
economic
way.
projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And I mean, there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to...
Mr. Mike, please.
Yes, sir.
Somebody
this
find the
woman a
mic
mic.
quickly.
Find the mic.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, and because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have a long, we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation, and we had several of those, and they're very good for people. You see late in an expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
Here it is. Here it is.
It's too early to say really whether.
Where's my soft landing notes?
Whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been
shit, can't find it.
Let me find
changes in that.
Soft landing notes.
The question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, in particular immediate attention. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
So you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, this review is going on. And, I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank. And under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance.
Hit him with it. Come
Curious,
on, Jennifer.
how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Sorry, that wasn't in my
Curious
notes.
how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it, and then once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, and so that's all I have to say. So, thank you very much.
All right. So let me turn this off over here because it's buzzing in my ear. There we go. All right. So let's get into it. So first of all, Crypto Fam, thank you for being here. We did start early today. If you missed that, you missed the first part of the Fed meeting. We wanted to make sure to get that out to you. Thought it was super important. This affects all markets. And so really important what we just heard. I think we heard a lot of nothing, but I think there's some interesting things that we definitely want to go over. Also stick around. We've got some interesting news happening in the crypto space. Telegram is got some stuff going on that's, I think, bullish for crypto. And there's some wild stuff going on over in France, as probably some of you have heard. So smash that like. Let's have some fun today. Crusader, kick it off, bro. What's kind of your overall macro thoughts on what we just heard?
Well, let me just kick it off with some TA before we get into that. So let's
Yeah.
show
Oh,
the
yeah.
chart
You know what?
here.
Hold on. Before you do that, pause. let's look at the markets like we normally would do.
Like the rates.
So we have got the global crypto market cap at 1.17 trillion with the T dollars. That's down 0.72%. But look at this. Bitcoin down 2.37% on this 25 basis points rate hike. Man, I wish I would have shorted. ETH down about 2.21%, rolling on down through the top 10. XRP is down 6.28%. Cardano looks to be the only one up right now, up 1.
It's resilient, just like the banking system.
Yeah, just like the banking system. Soft landings coming off of this news. Let's see what the TA says, because many TA experts will say, show me the charts and I'll tell you the news. Were the charts predicting this or not so much?
Go. I mean, it kind of was, it kind of wasn't, right? Like, so
could have gone up, could have gone down, you know?
No, so you can see here, right? We had resistance at $29,039, and we basically hit almost it. Dude, we were off by like $50. We hit 29, we hit 28, 960. So we're literally off by less than $100, give or take, to the resistance before we started pulling back. So there was resistance there. We've come back down to test close to this 27.1. If 27.1 can hold, and this can hold that support, doesn't mean that 30K is out of the door. We can still head back up, right? We've been trending. We've been on this heart line here of this regression trend going up and up. So if we can hold this, we can still keep moving up. The RSI is a little overbought, right, on the daily. So we could be seeing, like we've seen here, we've been seeing a red candle, green candle, red candle, green candle, right, kind of cooling off. MACD is coming back down, but it hasn't fully crossed just yet. It can still bounce off of there. If we come down to the 4-hour, you can see here again a little bit and better how close we came to this support line. Right, we basically almost almost hit resistance, basically almost hit support. So if we can stay within here, continue bouncing off the support line. Let's see what the MACD is saying. MACD is bearish right now on the 4-hour. RSI is coming down and cooling off on the 4-hour, so about halfway to the RSI. So you know that's what's happening with Bitcoin right now. I wouldn't call it a dump per se, but those resistance at 29, right? It's not going to be a straight shot to 30. And you know, with this coming out now, with the federal rate hiking 25 basis points, putting on a strong show for the people. Like, yeah, the banking system is fine because we're just going to keep injecting it with steroids until it keeps doing its thing. Right, we're going to keep raising interest rates at some point as more banks continue to collapse. There's already been reports of over 180 banks in trouble. If we start seeing more of these, and we start seeing the whole 18 trillion, all banks are going to be insured, they will have to stop raising interest rates, because you're not going to solve anything by raising interest rates and then injecting money. Raising interest rates, injecting money, right? Because the inflation is going to keep going. And what are you doing? You're just, you're double fisting a problem that is not going to get fixed that way.
Yeah. One of the things that I thought was interesting about this is we hear these people talk in circles, and I want to be clear. I do not envy Jerome Powell standing up there having to answer some of these questions. Now, a lot of them we saw him looking down at his notes. They have already effectively rehearsed these questions and answers. And then, a couple people kind of go off the cuff a little bit where he has to actually answer somewhat of a question. But what I think is interesting is the wordplay. Let me tell you why. Okay, so he was talking about raising interest rates, and he was talking about credit tightening. Well, here's the deal. If you actually know, so if you're watching this meeting and you genuinely know what he's saying, let me explain something to you. Credit tightening is regarding the federal funds rate. There's a thing called the federal funds rate in the United States, and it's effectively the rate, the interest rate, right, at which basically depositors, banks, can lend to other banks overnight without collateral. Okay, that's the federal funds rate, and the Fed sets that percentage. Okay, so effectively they can set that number wherever they want. And so when they talk about interest rates versus credit tightening, they're the same freaking thing. If they tighten credit, that means that they are changing the interest rates of the federal funds rate, which makes it either more or less expensive for these banks to loan money between each other. It's all playing with freaking magical numbers. That's all it's doing. It is playing with numbers. And at the end of the day, they talked about reserves. Well, these reserves have to come from somewhere. Okay, when they're talking about, well, how much do you have kind of in the hip pocket to use? Well, technically, they have as much as we're willing to print. And so when they say everyone is protected, be careful, because Crusader's right. If there's $18 trillion of liquid, what is it? It's $18 trillion in
Yeah, $18 trillion, like the whole banking system, if they
whole
were to
banking
cover
system.
the whole banking system.
Yeah, so if there's $18 trillion worth of money that would need insured, there's only one way that you're actually going to cover that should the whole banking system crash. Well, I got news for you. A couple trillion got us here. A few trillion got us here. 18 trillion is not going to look so hot, right? We overnight would the entire system would collapse. They know that. So effectively, we talk about this a lot. They're rubbing shoulders. They are speaking above most people's heads by not talking about the federal funds rate, but by calling it credit tightening when they're the ones setting the freaking rates. And so what I don't like is how they just try to finesse it. I would love it, love it, love it. And I understand, listen, some of this stuff is over my head and Crusader's head as well. There's some of the stuff that they get into that I genuinely don't understand on the back end, how everything affects something else, right? I'm not an expert on economic factors. But what I will say is what I do know and what I do understand, they are absolutely trying to just speak just over your head, make you feel good about what's going on, when really it's all fugazi. They're playing with magical numbers, moving things around.
Yeah, exactly right.
What it is.
Alaskan here talks about the employment numbers are crazily skewed. Of course they are, right? Because somebody else just pointed out here, people are working 2 to 3 jobs to deal with inflation. So it's like, oh, people just, the job market is just so strong right now. Well, duh, people are trying to survive. They're trying to literally get 3 to 4 jobs. Of course, people are not just quitting their jobs and just say, well, I'm just going to go to the bread line now. Might as well, start marking my spot.
And then the other part of that too, Crusader, was that it wasn't too long ago that Joe Biden was talking about the strongest labor market in history because of how many people got hired. Bro, you fired everybody from the freaking vaccine stuff that you did. You can't hire them all back and then say, we've got a strong, listen, we're hiring more people. When you freaking fire everyone and then you bring them back, you can't count them towards the freaking numbers. That's all.
But they do.
Throw out there. But they do.
But
they absolutely do.
Crypto Gamer says most important part was when he said they are no longer considering raising rates as mandatory and are considering pauses on new data. I mean, it has to be, right? Because if you see more banks collapsing, if we see this happen, just like we were mentioning earlier, they can't just keep raising interest rates and injecting money to save these banks. They can't do both.
Yeah.
I think this 25% rate hike was literally just a show of face so that they don't just back off instantly and so people freak out like, oh man, banks are collapsing and now they pause rates. Things are a lot worse than we expect. They're trying to keep, save face by saying everything's fine. We still got a soft landing. We're going to keep raising interest rates. Don't worry, guys. The banks are safe.
Yeah. There's a saying that says you can't save your ass and your face at the same time. And effectively, that's what they're trying to do because they know they're screwed. Now, how can we make this look as soft landing-ish-esque as possible? And what also we need to recognize is they always have an out to point at somebody else. I don't know if you guys noticed this, but when he was asked about what happened with Silicon Valley Bank, immediately he's pointing at bank management. And what they were talking about was all of the uninsured deposits that they had. We have a little thing in the United States called fractional reserve banking. When you allow an institution...
You mean fictional reserve banking?
Fictional reserve banking. When you allow these institutions to take on money, loan it back out, and not have to hold on to anything. I've talked about this before. Think about if you could just like rally up a bunch of money around the neighborhood. You walk around your neighborhood, all your neighbors, they give you money. You don't have to hold a dime of it. And you go to the next neighborhood over and you loan that out with an interest rate on all of it. Well, then when the neighbors across the way, the other neighborhood defaults on their loans and they can't pay for it, your neighbors in the neighborhood are going to come knocking. They're going to say, hey, where's my money? Well, I don't have it. I loaned it out over here. How can we not see that as a simple problem, right? How can we not see that if you're just allowing someone to make money, make something from nothing, and that is what it is. If someone has the opportunity to make nothing from something from nothing, they're going to take advantage of it and they're going to push it as far as they can. That is why fictional reserve banking is a problem in the United States, and we're seeing it shine full well. But they will point at bank management and say it was mismanaged. Now, I don't know the back end. There could have been a lot of mismanagement going on, and it very well could be true. I'm not suggesting that I know that it's wrong. I'm just saying that they are very, very quick to point elsewhere. Just like, I mean, just about, I guess, anybody, would try to again, save ass and face at the same time. So I don't know. Thoughts, Crusader, on overall? It's a 25 basis points rate hike. Okay. Not crazy. It's still a rate hike. We see the market moving a little bit right now. Let me peek over at it real quick. It is, let me update this. It is at, Bitcoin's at 27,291. So it's continuing to move down. It's down about 2.5% from what I'm seeing on CoinMarketCap. Are we going to see, do you
actually
feel like
slightly moving up right now? It's at 27.5.
I think it depends on obviously where you're looking.
The coin crypto market cap is delayed from the actual charts.
Yeah. So, but my question would be, are you seeing short term? Do you think we're just going to have a little bit of a bounce? Is this washing out some, or are we going to see a nice big move down to wash out a bunch of these longs from all the articles that they've been putting out and all the people they've been getting into the markets thinking it's going to 30, 35, 50K?
That's a great question. Let me look at my notes. So basically, right,
didn't have that one written down, did you?
So look, let me show the chart here real quick one more time just so that we can answer this question. Right, let's zoom out here back into the daily. Look what Bitcoin's been doing, guys. Look how strong of a move, right? This was huge on the 11th. Literally 11 days later, look where we're at, right? We went from
huge move
20,000 to basically 28, 29,000, $8,000, nothing but going up.
Yep.
You think people that are trading this aren't going to take profits?
Yeah.
Right. They're going to take profits. Right. So is that
big money is for sure, because that's a massive move.
Exactly. Right. Massive move. People are taking profits. We're considering this a dump. Did we forget like what a real dump looks like? Let me zoom out here for you guys. Like, hold on. Let me turn all these pivots off. This is a dump, guys. This is a dump, right? We went from 48 to 19 real quick, right? That's a dump. Us going down $1,000 right now on the day is not a dump. People are taking profits. People are trading this meeting. People are expecting this to happen, and profit taking is going to be a thing. So I don't think it's a big concern. I don't think we're going to drop rather certain support levels that we're going to be continuously looking at. But even if we dropped to 25, 26, where did we just come from? Where we were at 15,000 a month ago, right? And we've been doing nothing but going up, and we hit all the way to 28,000. So I think we're going to continue seeing banks collapse. I think this narrative is not going to get, it's not going to go away. Money is going to keep being injected into Bitcoin. People are going to keep running away from the banking system, and slowly but surely, Bitcoin is going to continue moving up. It's never going to be a straight shot to 30K blast off, right? We're not in the bull market, guys. We're not just going to blast off to 40, 50K tomorrow based off one guy speaking. It's not going to be like that. There's going to be profit taking along the way. There's going to be slight pullbacks, retracements. And that's what you want to see, because if you see just skyrocket up, you're going to see a skyrocket right back down, right? So you want to take it slow and steady. The halving is coming up next year. We've got possible rate cuts by the end of this year, right? Depending on the data that he gets in the next meetings. So we're just gonna keep an eye on it. But I think 30K is definitely in the cards for this year.
Yeah, all of this is really important, crypto fam. So we always talk about education. We've got some stuff coming up with some security tokens that we're going to be talking about and educating you with on that, because it's an important movement that's happening in the crypto space. But what I want to say is that if you can educate yourselves on monetary policy, I know it sounds boring, but if you have that information, even just the little stuff that I was talking about credit tightening and what the correlation between credit tightening is and interest rates and what that actually looks like, you have a better understanding like what's really happening. Try to simplify it and break it down. So hopefully us giving you a little bit of education, us rubbing your backs and telling you it's going to be okay. Get yourself some more education. Hopefully that is helpful. And yes, I believe that banks are Ponzi as well. So let's move on. So 25 basis points rate hike. If you just came in, smash those likes. This is brought to you as always by Danger Close Alpha. We are still minting 0.01 bullets, beans, bourbon, Don't forget, we can drop a QR code on the screen if you want to. Boom, hit that link. Check us out. We're giving away 5 Ethereum. So jump into the Discord and get involved with that. Okay, stick around. We're going to talk about 2 more things, one of which is on Telegram. Big crypto news on Telegram. I'm excited to talk about that. But let's talk about France first. France has had a lot of chaos going on. Okay. Now let's talk about how we've got lawmakers introducing possibly something interesting as it relates to crypto. French lawmakers agree to effectively ban crypto influencer promotions. It says social media stars couldn't tout unlicensed crypto products under a plan voted by the National Assembly's Economics Committee. It says the National Assembly Economics Committee voted in favor of a law designated to stop unsafe products or outright scams from being promoted by well-known personalities on sites such as Instagram and YouTube. They agreed to an amendment that forbid online influencers from directly or indirectly promoting crypto asset services from unlicensed providers. Now, listen, when you go further into this, okay, I'm not going to read the whole article. When you go further into this, nobody's licensed. So effectively what just happened, and it says in the article, effectively what just happened is they said, listen, you're not allowed to promote crypto. Okay, so now let's look at it macro. We have the collapse. The banking system is collapsing before your eyes, and people are turning towards crypto. They're saying, hey, maybe my money is more safe with something like a hardware wallet. Like we've got a ledger link down below the stream if you want to check that out, if you need a hardware wallet. Maybe my money is more safe in Bitcoin on a hardware wallet. Maybe I should actually take this crypto thing serious. And these banks and institutions and governments are saying, whoa, whoa, whoa. That's not the game plan. We can't have them doing that. And so France, who has a bunch going on with their pension funds, people are rioting in the streets. It's already getting crazy. Now they're saying, hey, listen, I know you've got tons of problem with our monetary policy right now and what's happening around our country. But while we're at it, crypto influencers, you can't do any promotional stuff on crypto because that would be bad for our banking system that's already collapsing in front of you anyway.
The problem is that what is defined as a promotion? Right? If I talk about Bitcoin, if I say, hey, banking collapse is happening, people are fleeing to Bitcoin, is that a promotion? Am I promoting Bitcoin right now? Right? Is that what's happening by just stating some facts that, hey,
I don't know.
Money is leaving the traditional markets because banks are closing, and being your own bank, aka hold crypto in your own ledger wallet, aka Bitcoin, makes you your own bank. Maybe it's something you should look at. Is that a promotion? Who do I speak to at the Bitcoin company to give me to get a license so we can talk about Bitcoin?
So we can talk about Bitcoin. It even says in here, it's not about killing liberty. It's about valuing the work of influencers. And you know what? I would tend to agree with that. Listen, when we come on here, and you guys see this, I know we work hard in the background to do what we do. We're head and hands into the crypto markets. And at the end of the day, we are working. So if we decide to partner up with somebody to get paid, there should not be a problem with that as long as we're doing what our due diligence, as long as we're disclosing it, as long as we're telling you, hey, like with Price CPA, shout out to Anthony. Like he is a partner of the stream. We are getting paid by him to talk about what he's got going on. But guess what? He's our freaking CPA, right? Like we will never promote something that we're not involved in or want to be involved in. That's just how we roll. And so I see no problem whatsoever as long as it's disclosed, as long as people know, because you've got to be able to make if somebody wants to shill some wild project and it's crypto, right? And that they're getting paid to shill this, it's your own daggone fault if you get into it just because your boy on YouTube was promoting it. That's your fault. You've got to have some fiscal responsibility for yourself and the decisions that you make. So that's why I don't like it. I just think they're trying to tighten the crypto.
How many influencers out there exist about like vitamins and all kinds of other fugazi products, right? And people literally come out, they tell you lies upon lies upon lies, but nobody cares because that only costs you money, right? You got to spend the money to buy these products, right? You're not actually having any potential of making money back because the minute you start talking about the word currencies, right? Assets, things that can make you money, financial freedom, being your own bank. Oh, wait a minute. That's not safe.
Yeah.
Be very careful there.
Yep.
Tread lightly on those waters. That's the biggest problem.
Velocity of money is how our money works in the United States and really around the world. Money needs to continue to circulate and move. And what Crusader's alluding to is that when people are just promoting, let's say, a vitamin, like he said, what are they doing? They're continuing that velocity of money. So that helps the Fed, that helps our government, that helps, promote that. The moment that all of a sudden we're like, hey, we're not going to so much create velocity of money as we are create some velocity into my own personal, well-being, my own personal future. Not so much. You've got to be a debt slave to the government. You will do as we say. We will whip you when you do not do as we like, and that's kind of what's happening now. Caveat: the undisclosed shill on whatever. The reality is, we have a responsibility as influencers to because people do look to us for information, education, and
I do 100% agree with disclosures. That for sure.
It is because at the end of the day, a lot of people will take the information and say, well, I'm sure that they researched this heavily, and if they're going to do it, they've done well in the past, then I should do it. And again, it's still your responsibility, but I think that should definitely be disclosed. So,
yeah.
All right, cool. Let's move it on. So smash the like while we're kicking on over to this next stream. If you haven't already, hey, share out the stream. Shout out to Greg Gressick. I see you in the chat, brother. Greg's our media manager. Shout out to Greg. He's been doing a great job and working hard for us as always. All right, let's talk about Telegram. I'm really interested in this. Telegram users can now transfer USDT through chats. So USDT has been added to Telegram's app, the wallet bot, expanding the messaging app's facility for buying and selling crypto, according to an email announcement shared by CoinDesk Wednesday. Integrating crypto payments into messaging apps like Telegram, in theory, rendering sending cryptocurrency as easy as sending a text or a photograph, should be an extremely positive development for mainstream adoption. Stablecoins like USDT offer many the benefit as other cryptos do, but without the price volatility that often beset the likes of Bitcoin and Ether. Okay, so Crusader, we use Telegram often. We send messages back and forth. We're in like influencer chats. It's how we communicate when we're at events. We use Telegram a lot. Why do you think that this is going to be a good thing for the crypto world? Something as simple as just being able to use,
Well, it's because you said it right there, right? Because it's simple. Something to make ease of use, right? To just simply be able to jump on Telegram, something that most people know already how to do, and send a message, which will actually be a transaction, sending money from point A to point B, right? Gets around the whole wallet address. What's your crazy wallet address? The digits change, right? All this stuff. And this is not the first time I see this. This is now with Telegram. But in certain countries in Africa, and there's a company that I can't remember their name right now for the life of me, but people can send Bitcoin through the Lightning Network on text messages. So meanwhile, you have just cellular signal. You don't need to have internet, right? Because these countries, most of them don't have any internet, but you have cell signal. You can send transactions from one person to the next just through simple text messages, which is very, very beneficial, right? You don't need the internet. A lot of people worried about that. So meanwhile, they have signal, they can do it. And now adding it to Telegram. And there's a company that is trying to do this within ease of use as well. That's trying to just make it more broad to everybody, where they can just jump in there and make any transaction. All you need is cell signal, no internet. So there is definitely something very beneficial to the space, making it easier to use. Always.
So I totally agree. The ease of use, just as simple as a text message, boom, I love it. So let's play the other side of this. Could this be a play or a move to effectively farm more data and get more people on par with doxing themselves effectively, right? Because Telegram, though it is, and I don't know the inner workings of Telegram, but it's attached to my cell phone. And so the moment that I send, and you can do it from your computer or whatever, but as I recall, I think you have to have a cell number, I think, to use Telegram, right?
Yeah.
And so effectively, if I say, hey, Crusader, send me some USDT over Telegram, that boom is going from your cell phone number to my cell phone number. So could this also, on the other side of things, be a weird backdoor way for our nation, our economies, to get some more access into crypto that's being transferred around, or is this going to be the new norm?
Yeah. Yes, that's exactly right. right? It's going to happen.
Yeah.
But there's always going to be trade-offs, right? There's different ways to keep yourself private. There's different ways to get extra cell phone numbers that are not actually physically attached to a physical phone.
Yeah.
There's ways to use all kinds of things to protect your data one way or another, to add some layers of privacy along those routes. But it's one of those things, right? Centralized exchanges get all your data, right? Everything we do on Instagram, tickety tockety, everywhere, they're eating up your data. So
yeah,
it's just one of those things you can't really get around. They're always going to be mining for data.
Puddles said, "Oh, a soundboard now." Yeah, Puddles. Just a shout out to you and the rest of the crypto fam. Wanted to tell you guys, if you hadn't noticed already, we do have a soundboard, but it's more than just a soundboard. We have a Twitter space every single day now, 3 p.m. Eastern Standard Time. That's going through Danger Close Alpha, our NFT project. If anybody wants to come up on the YouTube live stream, we're trying this out. Toss us a super chat. Put in the name of your Twitter handle, and if you guys want to come effectively on like a caller to you would be a call-in caller. It will broadcast through YouTube. If you'd like to do that and ask any questions about anything we've talked about, drop a super chat, and we'd be happy to bring you up and talk about it as we continue to grow. We're excited about the possibilities, the things that we're doing in the background to give you and produce a better show. Ultimately, long term, we'd love to be in the same state. We'd love to be in a studio together. There's a lot of things that we are aspiring to do, and we've got to start somewhere. So if you want to support the stream and do that, we really appreciate it as well. All right. For today, anything that I am missing, or we kind of wrap it up from there? Yeah.
No,
Okay.
I think that we hit everything we needed, right? We hit the FMLC meeting. We hit we hit the Telegram. Just Bitcoin in general, the market, what's happening. So
Greg,
people just need to.
Greg, thank you very much. We appreciate you. We love you, bro. We will definitely do that. Let's, dude, you did not need to do that. Thank you. All right, so Greg, $50 super chat says, "Can you give a price prediction at the end of 2023 for your 5 favorite altcoins? I've got bags in the entire top 10." Okay, cool. Let's both do it real quick. Let's do it.
Ooh, that's a good question.
Price this is good. Okay. But I'm gonna have to pull these up. Let's see here. 5 favorite alts. All right. So let me pull up. Hold on. I'll start. I can start. All right. So end of 2023. I'm gonna tell you, this is gonna sound like a cop out on a couple of these, but it's genuinely where I feel like we're at. Okay. So one of mine is XRP. Okay. I have no freaking I have no freaking idea. We're down almost 11% right now, by the way. I have no idea where we're going to be at with this case. However,
So much for that 20% pump yesterday.
However, I believe that we will be north of $1. So I'm going to go with north of $1, south of $1.25, somewhere in that 1 to 123 range for XRP, because I do think we're going to win this case. I do think we're going to see a big pump, but I also believe that we're going to have something happen in the background this year that's going to bring us back down to earth. So XRP, number 1, Cardano. I'm going to say we're actually going to be somewhere around
60 cents.
I was going to say 50 cents. I was going to say 50 cents. Again, I see a pump happening in the markets, and I think we'll hit way higher than that this year. But then I think we will drop back down. Polygon Matic would definitely be one of them. You know what? I was gonna say I think maybe like even 175. I could see a big move from here. They've been making huge partnerships. I love Polygon, like what they've been doing. I could see a move. You're thinking around 150. I'd say about 175.
Yeah, it all depends where Bitcoin's at the end of the year, right? If Bitcoin moves all the way to 35, 40,000 and then drops before the end of the year back into lower levels, then it all depends where Bitcoin is at.
Exactly. VeChain, baby. I know Crusader loves this is another one Crusader loves. My commie coin here. I want to see VeChain at least at 3.5 cents. So another 50% move from where we're at right here would be massive. Again, I still think that we're going to come back. VeChain's been all the way up at, I don't even know, 26 cents or something like that. We've seen some great numbers out of it. I do believe that we'll.
And by the way, these price predictions are not backed by any technical fundamental analysis.
No.
These are just numbers out of the top of our head, based off where Bitcoin could possibly be and the altcoins having some type of move.
And
Magic
last
Email
one for
says
me
price
was
prediction for USDT by the end of the year. I think $1.10.
$1.10.
$1.10 is possible, dude. So it's been absorbing so much money with these other stable coins, having issues.
Yeah, that's. I mean,
If we see
I
more
could
bank
see it.
collapses, we're gonna see that.
I could see it for sure. That would be wild, and that would be very unstable for everyone involved. And then Audius is the one you guys hear me talk about a lot. Audius is at 27 cents. I could see Audius maybe creeping up towards, I don't know, 35 or 40 cents. It's part of the reason, and I will say this. So, Greg, thank you again. Part of the reason that and Crusader, did you have one or two more? I know Audius wasn't one for you. That's decentralized music streaming. For whoever's wondering, it's a bag of mine that I've really watched for a while now and have done well with. But I wanted to say, part of the reason why I didn't make any huge predictions, it's not because I don't think we might have a huge number at some point this year. It's because I believe that we are going to have a huge drawback as well. So big pump, big move, big drawback. That's kind of my thought processes on the rest of this year. So kind of where I'm at. I don't know about hey, Magic. I'm going with 99 cents to $1 on USDT, brother. So Crusader can go with the $1.10. I'm going to play it safe. 99 cents to $1, brother. That's where I'm going. And then Crusader,
risk it
tell
for
me,
the biscuits, bro.
give me at least one that I didn't throw out there. What do you got?
One that you didn't throw out there would be. Let me see. Let me take a quick.
I know we have a lot of very similar likes as it relates to.
Yeah, I would say.
And I didn't say ETH. ETH's my favorite. You guys know.
I'm gonna talk about Dogecoin. I think Dogecoin can hit 14 cents.
What's it at right now?
7.
100% move. Why?
Yeah. Huh? It just takes Elon to just buy something and just say, all he needs to do is buy one of these banks that are collapsing, saying, hey, everybody's deposits are going to be converted into Dogecoin. Boom. $1 Dogecoin. But I'm going to call it safe at 14 cents. That's all it takes, bro.
Crypto fam, you can see some wild stuff in these markets. Continue to keep up with us. We are here Monday through Friday, 3 p.m. Eastern Standard Time. We appreciate each and every one of you and love you. We know that you could be anywhere, but you are here hanging out with Debate Crypto. So Monday through Friday, 3 p.m. Eastern Standard Time. Don't miss the show. We're here every day, so question everything.
Trust nothing.
And until next time, hodl
like it's hot.
We'll see you soon.